Hi everyone, my name is Jason Choy, Senior Portfolio Manager at InvestNow, and welcome to the July 2024 edition of InvestNow's Market Wrap-Up. At InvestNow, one of our guiding investment principles is to stay informed but avoid the noise. That means while we recognize that it is important for investors to keep abreast of what's happening in markets, we also believe that investors should be mindful of resisting the urge to change their long-term investment strategy solely in response to market volatility and noise. We know, however, that financial markets can often feel unnecessarily noisy and complicated, with so many headlines clamoring for our attention. It can be hard to keep up with what's relevant and what isn't. But don't worry, InvestNow is here to help. Each month, together with one of our expert fund managers we have on the platform, we'll distill the key events in the wide world of investments into digestible bites curated for the Kiwi investor. We've got a special double whammy edition of the Market Wrap-Up today, as I'm joined by not one, but two guests in Andrew Ormsby and Mark Donnell, investment managers at Lighthouse Funds, one of the expert fund managers we have on the InvestNow platform. Lighthouse is a boutique active investment manager that offers the Lighthouse Global Equity Fund, a concentrated high conviction portfolio tilted towards large cap growth assets, which is a strategy that the Lighthouse team has been running for over a decade now and has generated nearly a whopping 20% in returns per annum since inception. Andrew and Mark have decades of financial services experience amongst them, so we're fortunate to have them join us today to help break down an interesting month in markets over July. Andrew, Mark, thanks for joining us today.
Cheers. Thanks, Jason.
Thank you. Thanks, Jason.
So let's kick into the market wrap-up, shall we, fellas? As it's certainly been a busy month. So, guys, July has come and gone, and we've certainly seen an eventful start to the second half of the year, handily summarized in this market dashboard we have here, which outlines the performances of a few key indices, as well as local and global shares and bonds. Andrew, Mark, were there any particular pockets in the market that stood out to you guys?
Look, Jason, I think in July, if you look at that chart there, really New Zealand shares and New Zealand property had a great month, and I think that's largely on the back of interest rate expectations changing quite rapidly here in New Zealand, which I'm sure we'll get to later in this session. But that's quite a local effect, and so you see in the other asset classes like US shares or global shares and so on, there's that didn't really feature. They're on a more predictable, expected path for interest rate movement. And so that sort of one-off event was more of a New Zealand effect. You also see Bitcoin, which we kind of view, Bitcoin's a completely valid asset class, but it exists in its own universe, quite disconnected really from most economic fundamentals. And so it's been a stellar period for Bitcoin over the last 12 months, but it kind of exists in its own world, and it's very hard to draw any analogy from what's happening there across to other asset classes.
Cool, thanks, Mark. So as you kind of touched on, while the dashboard here seems to indicate quite a bit of a sea of green across most asset classes over the month, if we looked into the details a bit more over July, it was really a month for two halves. So we saw kind of all-time highs in early July, but then a substantial drawdown in the second half of the month. So, where many major indexes saw some sizable pullbacks from the all-time gains. Fellas, what were the drivers behind the sudden pivot in markets when, seemingly the majority of 2024 had otherwise been doing so well? I think the S&P 500 hit like 38 different all-time highs, and then all of a sudden, any insight?
It did. Yeah, Jason, look, you're 100% correct. July was a month of two halves, most definitely. Our fund, Lighthouse, saw a record high on the 10th of July, very quickly reversed course later in the month as we caught the leading edge of that downdraft. We think there were three main areas that contributed to growth stock reversal in that second half of July. First one is the Fed did not cut rates in July, all right, which fueled speculation that the Fed is behind the curve as inflation falls, just as it was when inflation was rising. So they did signal a September rate cut, but that didn't keep the market particularly happy. The second bit was that the day after the Fed decision, US employment data showed a slowdown in job creation, so which also rattled markets. Now, to be fair to the US, it was adding jobs, but just not as many as they had expected. So those two things were contributing factors. The third one was around US earning reports, which showed that the big US tech stocks continued to spend heavily on AI infrastructure, But the path to AI revenue, let alone profit, is still quite murky for most investors. So they got particularly nervous. And this spending or heavy spending impacts on what we call free cash flow of stocks, and that the less free cash flow you have weighs on the share prices. So I think if you take all of those three areas, plus the Bank of Japan delivering an outsized rate hike, plus less what we call beat and raise type share announcements, so that's less stocks beating expectations and less raising guidance, it impacted on the future outlook of those stocks.
Thanks, Andrew. So as you've kind of touched on, over the month, we saw a significant rotation from kind of growth/large cap to valued and small cap, and tech stocks, as you touched on in particular, were particularly hit hard, amid questions like, is all this AI spending really going to lead to all the growth that market valuations are implying in some of these stocks? So guys, I'm keen to hear your take on this, as I know Lighthouse is tilted towards large cap and growth in particular, so I know this is near and dear to your heart. Do you see any validity to some of the recent kind of AI concerns, and do you kind of see this correction as a time to take profits and kind of get out, or conversely, do you see it as another opportunity to just double down in your current strategy?
Look, I think what you see with the value stocks is that they're more interest rate sensitive. A lot of that sort of Russell 2000 type stock, which in American terms they'd call small to mid cap, and we would think were very large companies by our context, right? So these are not mum and pop stores. They're sort of Fletcher building type businesses, but they tend to have debt, and with the higher interest rates in recent years, servicing that debt's become quite a burden. And so they're going to get quite a lot of relief you'd expect over the next sort of 18 months as interest rates drop. And so this is sort of an event-driven boost in their valuation based on interest rates rather than the sort of underlying fundamentals of their revenue and cost control and so on changing. And that's quite proper. So you are seeing a legitimate improvement in their future fortunes based on interest rate movements. We tend to try and look past or beyond those sort of external economic factors. Our philosophy is more that if you've got a really strong business, it should be a good, strong business, regardless of whether interest rates are at 5% or 3%. And if you're growing your revenues and your profits at 20% per annum, then again, whether interest rates are 5% or 3% it's noticeable, but it's not crippling. And so those businesses that we tend to be exposed to, they won't see so much direct change in their fortunes as interest rates drop. What you will see is that the share prices should rise because interest rates are a big input into that sort of complex valuation formula. And so we would expect to see the growth stocks are going to benefit as interest rates fall, but they're probably not the first cab off the rank.
Nice. Thanks, Mark. So let's touch on some of the activity we saw in the central bank space over the month, which is probably a nice segue to explain some of the volatility we've seen in markets recently. So at the end of the month, we saw the Bank of Japan hike rates for only the second time since 2007, which caused the yen to appreciate and fueled quite a lot of market volatility. Can you guys give me some insight as to why Japan is seemingly bucking the trend and hiking amongst a swath of easing cycles worldwide, and why the moves of this kind of small island country that's just about the size of New Zealand has such a significant impact on global markets?
Thanks, Jason. Well, firstly, the Bank of Japan does not hike rates often. So the Bank of Japan has only raised rates twice since 2007. First time in March this year, and then again in July. Unlike the rest of the world, there was moderate inflation building in Japan. So what they decided is they needed to lift the rate from 0 to 0.1 to 0.25%. I mean, the numbers are so small, right? But it was actually 0.005% higher than the market expected. Okay, so that helps create some of the turbulence. Secondly, and the main reason we believe that the Bank of Japan went is they did not like the weakness in the yen versus the US dollar. So the yen had weakened from 141 yen to the dollar in January to 161 yen to the dollar in July. So part of this rate rising strategy is to help shore up that value, which has actually worked, as the yen is now back at 147 versus the dollar. But unfortunately, over this period of low Japanese interest rates and a weakening currency, we saw a large number of offshore investors get involved in what they call the carry trade. So they would borrow money in Japanese denominated debt and buy other assets around the world that usually had a higher yield. What happened here is that when the Bank of Japan lifts rates, it plays havoc with that carry trade. So the first thing is, if the currency strengthens, they're going to get hurt. Secondly, as interest rates go up, they're going to get hurt, right? So what we saw was an unloading of stocks in other jurisdictions to help fund the higher borrowing cost in Japan, but also an unwinding of the carry trade. Okay, so really the carry trade got a double whammy from the Bank of Japan's move. And it also didn't help that it was an outsized move as well, which saw that their share market dropped 10% in a day. I mean, it has recovered since, but that is, in one simple move, shows how interconnected all those world markets are with, investors.
Great summary, Andrew. And kind of moving on to the other major central bank narrative for the month, we saw the US Federal Reserve, as you touched on earlier, hold interest rates again for the month for seemingly the last time, with all eyes now on September for, what many expect to be the first in the easing cycle for the US. So fellas, what are your views on the timing and quantum of the Fed easing cycle? Can we expect 25 or 50 basis point cuts in September, or how many cuts do you see to round out 2024?
Look, I think our take, Jason, and look, we'll all just have to wait and see. So this is sort of our speculation or our base case. I don't believe the Fed will do a 50 basis point cut, because that will smack of sort of drastic and sort of worrying movements. So they will want to be steady. The difficulty I think the Fed has had is that they were slow to react as inflation started to lift, and they arguably let inflation get higher than it should have otherwise been if they'd acted quicker. And they have consistently said that they're going to be data driven from here on, in terms of we want to see some hard economic numbers around employment and inflation and so on before we move. And the difficulty is that means you're always working off historical information. You're always a month or two behind where the market thinks you should be. And there's a lot of short-term noise in some of these numbers. So we saw in the middle of July the unemployment number, which was unexpectedly higher than the market had expected. And we still don't know whether that's noise or if it's a true read. We'll need another month of data. So you have the Fed, who I think to some extent have backed themselves into a corner where they are waiting to see data, and because of that wait, they're now behind the curve. So I think what we're going to see from here on going forward is it's clear they need to cut. If you take the last 3 months of CPI inflation in the US and annualize it, that's running at 0.4% per annum. Right, their inflation in the last 3 months was 0.1%. So they have defeated inflation. Now they need to act. I think we're going to see 25 basis point cuts pretty much at every meeting for the next 12 months. We suspect that the sort of the final ending point of this is an interest rate number that looks like a 3. It's not going to go back to the almost zero interest rates that we saw after the GFC. And that's probably a healthy thing. I think those interest rates were too stimulatory, and they didn't allow the Fed any headroom to further cut rates if the market or the economy had turned bad. So hopefully there's a nice steady course for the next 12 months.
Cool, good summary. And like as you touched on, Mark, no one has a crystal ball, so everything data dependent, and things can change significantly in 6 to 12 months. But I think it's
in a month's time, I could look quite foolish.
And we're not going to hold anyone to anything here, but yeah, it's basically a good summary of what the data is currently showing us. And cool, probably the other major event over the month, and we kind of touched on. We try not to get too political here, but it's worth touching on, what's happening in the US election space. So kind of over the month, we saw quite major events, really, like Trump survived an assassination attempt, Biden resigned from after a less than stellar debate showing and subsequently endorsed Kamala Harris, who's basically set to take on Trump at the November elections. Guys, do you have any thoughts on what these recent political revelations kind of all mean for markets going forward, with US elections really just around the corner?
Yeah, I mean, they're not that far away, right? It's only sort of 2 or 3 months. But still, history says that US equity markets don't really react to presidential elections and also other big political events until quite close, much closer yet from where we are now. So I would think that no one can really call this election at this stage. And on that basis, equity markets are just going to sit there and say, well, we'll assume basically the current economic settings just carry through. Interestingly enough, it's sort of bond markets tend to be much better at, or much more interested in political and geopolitical events, and they impound expectations there quite quickly into their interest rate expectations. And what you see at the moment is a slight sort of deviation or spread between US bond markets that have progressively over the last couple of months got a little bit more bearish, and US equity markets that have stayed relatively bullish. Now, typically, I would say bond markets are better at reading the economy than the equity markets are. But I'm just not sure at this point whether that's right in this instance, because the tailwinds in the US economy are relatively bullish. We're about to start a program, you'd think about to start a program of interest rate cuts. The economic data is still solid, corporate profits are rising and forecast to continue to rise. So I don't quite see the setting for some sort of crash or big bear market, but that's where bond markets, the debt markets are leaning at the moment. We'll have to wait and see.
Yep, which certainly will be an interesting few months coming up with the election, but yeah, watch the space. Cool. Now, turning to events relevant to the Kiwi investor, the New Zealand share market, you guys kind of touched on earlier, finally awoke from stupor, returning nearly 6% for the month as the New Zealand economy as well as business confidence remains bleak, which has actually fueled some optimism that interest rates will fall much quicker than anticipated. The RBNZ looks like they're finally taking notice and seemingly pivoted towards rate cuts now, whereas recently it's just May, a couple of months ago, they weren't forecasting rate cuts until mid-2025. So guys, can you give us some insight into what some of the main drivers are behind the seemingly RBNZ massive U-turn in just, kind of 2-3 months?
Yeah, Jason, I think it's a really interesting situation we've seen in New Zealand. Economic activity has limped along after the sugar hit of COVID. So, but on the flip side of that, we've seen really high levels of employment, which has provided households with confidence to spend, and therefore has kept the inflation rate higher than the RBNZ would have liked. So what they did is they moved us into a very restrictive monetary policy regime to try and engineer a slowdown, which they were achieving. But actually, we think there's a couple of things that have forced the RBNZ's hand over the last little while, if you like. The first one is government actions and fiscal restraint. We've seen this government come in, they've cut public sector jobs, they've cut public sector spending on non-essential areas. This is a big change from the fiscal expansion of the previous government. And this has had big effects on business and consumer confidence. And we have started seeing the unemployment rate rising. So this has really helped the RBNZ's cause. The second part, we think, is pressure from the wholesale markets. And Jason, as you can see from that graph, the wholesale markets have identified the slowdown really quickly. And they've priced in substantial rate cuts between now and Christmas 2024. In fact, at one stage, they had over 100 basis points of rate cuts priced in, and probably still do. I haven't looked in the last couple of days. The question is always who is right? Is it the RBNZ, who say they wouldn't start cutting rates to August 2025, or the market? And in our experience, more often than not, it's the market. All right. So and we'll see. This restrictive monetary policy setting that the RBNZ's had us on has seen that what they call the neutral rate in New Zealand, which is the rate where interest rates are neither stimulatory or restrictive, drop to 3%. Okay, now this is a far cry from where the 5.5% we were sitting at just recently, right? So in order to get that rate down to somewhere near that neutral rate and to stop being restrictive on the economy, then we're going to see substantial rate cuts over the next 12 to 18 months. So I would envisage that we're going to see at least 25 at each meeting, and depending on data, we could see some 50 basis points cuts thrown in. And this is all obviously helping the NZ share market, which is obviously very forward-looking.
Yep, perfect. Thanks, Andrew. So you've heard it here first. Rate cuts coming. If they don't happen, you can blame Andrew if your mortgage sharing mortgage becomes too expensive. But yeah, I think we're light in the tunnel, guys, right?
Yeah. I think the caution though, Jason, is that what you're seeing is that the RBNZ, I think, as Andrew said, has had its hand forced, because in particular the government's policy position is a lot tighter, and the underlying economy is weakening as a result. And the question has to be, is that just a short-term weakening and then we get through to greener pastures, or is it a harbinger of a recession? And so at the moment, we're all quite happy in that interest rates look as though they have come down and they're going to continue to come down. That's helpful. Yep. But if the reason they're coming down is because the economy is weak, then that's also a shadow over everything that we need to be aware of and just watch closely.
Yep, definitely going to be an interesting few months for New Zealand. But yeah, as we kind of touched on earlier, light at the end of the tunnel. Kiwis can start seeing it, but it is still going to be relatively tough in the short term. Cool. So that's been a great summary of New Zealand. Let's turn to the chart of the month then, which is provided by Lighthouse, which here outlines some of the volatile performance that the S&P 500 can see during the year versus its ultimate return in the full year. So guys, do you want to kind of walk us through the investment insights and lesson here that your chart outlines?
Yeah, I mean, look, this chart actually comes from JP Morgan, but it's a great chart and tells a very simple but valuable story. The grey columns in the chart is the annual return of the S&P 500. It's in US dollars, so it's a little bit different from what a New Zealand investor would see. But what it says is that in most years, sort of 75% of the time, the S&P will have a winning year. And yes, absolutely, there are years where it can lose money over the course of a year. But the long-term story for investors is good. The red dots show you that within that calendar year, what was the biggest short-term fall from shall we say, an interim peak of the index to the interim low. So we've just seen a similar move in July and August in the S&P 500 this year. So I think actually this is as at the end of July, this chart. So that red dot for 2024 will actually be further down because we're continuing losses into August. But what it basically, the takeaway from this chart is that every year there's a pullback or a correction. There's some sort of technical terms as to the extent of the loss and whether we classify it as one thing or another. Occasionally you get a bear market. Even more occasionally you get a market crash like we saw with the GFC or the dot-coms. So those are a reality, but there's short-term volatility. The long-term story is still that stay the course and there are handsome returns to be made. And that short-term volatility is quite emotionally distressing at the time. No one likes to see, the value of their investment going down. But that's kind of it's the price you pay for the long-term story. It's sort of the entry price or the ticket price. I wish it wasn't that way, but it is. And look, the reality, especially of equity markets, is that in the short term, the pricing is driven by the most sort of hyperactive participants in the market, the most excitable people. They're what are pushing the price up or down tomorrow. You need also at the same time, there's a calmer, more logical, rational set of investors and you see their influence over the longer term, pushing prices up. There's this, the obvious long-term story is that share prices go up. So yeah, with things like July and August, it's uncomfortable. But really it's just a case of stomaching that and staying the course to achieve the better, when I say that sort of medium to longer term returns. So, 3, 4, 5 years, you should see good returns from equity investing.
Yep. Well, really well put, and lines really well with some of the now investment principles that we have as well, which is, we want investors to be aware of what's happening in markets, but, still stay the course. So, and it's no more better exemplified in some of the recent volatility that we've seen. We're making mainstream news headlines, but then markets recover pretty quickly. So it's almost, I think you guys had a good quote, was it something along the lines of, if part of the investment journey, to be a good investor, you don't need to have a big brain, you need to have a big stomach to actually see out
sort of your stomach is the key organ. I think the other thing I'd say too, Jason, is that when you see a pullback or a correction like we've seen in the last few weeks, what tends to happen is that you lose or you sacrifice the previous month's worth of gains. It's around about, typically it's about that sort of extent. So if you were happy in mid-June, you would have been happier in mid-July because you were up higher, but at the low after that correction, you still should be back to around about where you were in June. It's not like you've lost everything. You've just foregone the last month of gains. And what you tend to then see is that around about half of that loss gets recovered quite quickly. And we've seen that already now as we sit here in sort of mid-August. And then the other half of that loss might take another couple of months. But the reality is there will be new highs yet. The market will go on to recover all of that ground and press on into even higher positions. You just have to be patient.
Exactly. Cool. Perfectly summarized. And so that's really been informative, guys, and a great wrap up on events that occurred over the last month. So like you mentioned, we've certainly seen some volatility as of late, but let's probably finish off on checking in on your thoughts in terms of the market outlook for the rest of the year and what this means in terms of positioning within your Lighthouse Global Equity Fund going forward.
For the rest of the year, again, you're asking me for a crystal ball. That my crystal ball's quite grubby, really. I look with that obvious proviso, right? That all of this is just our view, and it's very lightly held. We'll quite likely have a different view in another couple of weeks as more information comes through. But right now, I would think that for global markets, it's fairly optimistic. Economic, the Fed and other central banks seems to have engineered, the sort of landing that a gymnast at the Olympics would be proud of, where inflation has been squeezed out, but without crushing the economy and moving things into recessions. And it's proper that they now start to sort of loosen the restriction a bit and drop interest rates. So I'm expecting that's going to be the big narrative for the rest of the year, is interest rate programs of interest rate cuts in all of the developed economies. There'll be a little bit of sort of political instability with America, but I think broadly the US economy just carries on regardless of the nature of the president. There's actually the president in the United States has less influence over the overall US economy than you might think. So not overly worried about that. I think the big question will be, as interest rates are cut, do we see inflation start to reignite? I think that'll be the story for the next 12 months, really. I suspect the answer is we won't. That we have genuinely squeezed inflation out, and we can do a program of interest rate cuts safely. But that will be the big question coming over the next 6 to 12 months. Do we see inflation tick back up again?
Cool. Perfect. Thank you so much, Mark and Andrew. Great insights once again. And if you guys want to learn more about Lighthouse and all the great work that Andrew and Mark do, check out the Lighthouse landing page on investnow.co.nz, where you can find out more about the Lighthouse Global Equity Fund offered in InvestNow. Thank you so much again, guys. That's about a wrap on this month's edition of the InvestNow Market Wrap-Up. We'll be there with you next month as well. Thanks, Andrew. Thanks, Mark. See you guys next time.
Cheers. Thanks.
Thank you. Thanks, Jason.